Hey guys, welcome to another technical analysis tutorial. In today's video, we'll be covering Fibonacci retracements. We'll look to cover what exactly Fibonacci retracements are and how they apply to trading. We'll look at the background of Fibonacci and look at applying that to a real-life example. We hope you find this one useful. Check this one out. So a bit of background on Fibonacci. Fibonacci retracements are based on a key number sequence that was identified by mathematician Leonardo Fibonacci. In terms of technical analysis, these retracement levels effectively act as hidden support and resistance levels. So the way this has been adopted in technical analysis is a Fibonacci retracement is created by taking two extreme points, a peak and a trough, on a chart and dividing the vertical distance by the key Fibonacci ratios. These are 23.6%, 38.2%, 61.8%, and then there's 50 and 100%. Now 50 and 100% is also used on the charts even though they're not actual Fibonacci retracement levels. Fibonacci retracements can be used to predict potential movements in price, and we're going to look at an example of that shortly. It should be noted that Fibonacci retracement levels work best when the market is trending. Now a bit of maths here, guys. Don't worry, don't freak out, it's not going to be anything complicated. But what we're going to do is go through the science or the logic behind the numbers I showed you, 23.6, 38.2, you're thinking, why is it showing me these random percentages? We're going to now explain how those percentages have come about. So Fibonacci retracements are based on a unique property of this sequence in front of us. So we start with 0 and 1, and it continues to infinity. The way the sequence works is it takes the current number in the sequence and adds the previous number to it. So the resulting number you have, for example, if you start at 2, add the previous number 1, you get 3, and then at 3 you take the previous number, add 2, you get 5, and so on, and that continues to infinity. So then, here's what happens. If you take the number in the sequence beyond the initial few and divide it by the next number, you should get an approximation to 61.8. Let me show you. So for example, if you take 13 and 21, if you divide those two numbers together, you get 0.619. If you take 34 and 55, divide those two numbers together, you get 0.6181. Divide 144 by 233, 0.61803. And so you can see, if I go further down the chain, the number that we're getting is closer and closer to the 61.8%. That's what one of the first retracement levels are. So if you remember, I showed you those random percentage numbers. 61.8 is one of those numbers. Now, let's say instead you divide your number, or the number that you have in the sequence, by two numbers ahead of it in the sequence. Let's see what happens. So for example, let's try again 13. So this time, instead of dividing by 21, we divide by 34. So 13 divided by 34, 0.38235. We take 34 and divide that by 89 instead of 55. You've got 0.38202. And so what you notice is as you go further down the chain, you get 31.2%. Another retracement level. But it doesn't stop there. If you instead take the number in the sequence and divide it by three numbers ahead of it, you get an approximation of 23.6%. Another retracement level. Let's check this out. So if we start with 13 and divide that by 55, you get 0.23636. If you then take 34 and divide that by 144, you get 23.6. Again, 144, divide that by 610, 23.607 this time. And you can see the further you go, the closer you get to that exact point of 23.6. So the accuracy improves as you go further down the sequence towards infinity. So that's how these random percentages that I was showing you earlier are configured and derived. So I wanted to show you guys this to give you the background and the context of why these numbers are significant. Now we're going to have a look at how this works in trading. So here I'm using GBP USD, the currency pair, and we're going to use the Fibonacci retracements to predict the potential movements in the currency pair. So this is a daily chart from March 2020 to September 20. So let's have a closer look at this. So firstly, let's have a look at this 23.6% level. Look at how in late March price broke out of this area. You can see that it was clear resistance because after the price broke through that area, it surged. I should note that this currency pair plunged just during when the pandemic was first announced in March. So what you're seeing here is a rebound in the price. Then, once price surged, look at where it found resistance, around the 61.8% level, suggesting that was strong resistance. You can see even a couple of false breakout attempts in early April and May, only for price to reverse, confirming this is resistance. Then if we look at the 38.2% level, that acted as strong support. So once we had those two false breakouts, price did fall back, and look where it found support, right on the 38.2% level. Then if we have a look at the 50% retracement level, you can see that acted as strong support in July when price corrected. This area held and led to the next leg in the rally of GBP USD. And then if we look at the 100% level, you can see that couldn't be breached on a number of occasions. You can see that throughout August. However, price did eventually break towards the end of August, but again, look at what price is doing. It is looking to confirm previous resistance is now support, with the price reacting sharply off the 100% level. So this is a good example of how Fibonacci retracements can be used in trading. Just to bear in mind, the 50 and 100% retracements are not actually part of the sequence, but they've been added as part of trading. The traditional percentages are the other three, but you can see how price does respect these areas as hidden in support and resistance levels. So again, it's another tool that you can use in your trading, and certainly something to be aware of when looking at price and turning points. Again, I hope you find this useful. Thanks again for watching. Take care.